Welcome to our channel where we provide valuable tips and tricks on how to invest in a stock market. Today we are going to talk about qualitative analysis. This analysis captures the qualitative aspects of a business. Well, qualitative analysis is highly subjective. It is also a non-mathematical study by investors to make an investment decisions. Some traders believe that knowing the integrity and skills of a company is the best way to judge and decide on an investment. The first and foremost step in the qualitative analysis is the management background. There are no bad companies, only bad managers. You will hear every great investor stress the importance of company's management. But for retail investors like us, it is hard to directly assess the management. On the other hand, management quality isn't quantifiable, and unfortunately, we cannot use interactions to judge each management. But despite this, there are still a considerable number of factors that help retail investors to assess the quality of management. The very first step in assessing the management quality would be finding the background of the top management and promoters. This would include their accomplishments, education, experience, and the performance of the company under them, and any other relative information. If they have accomplished good and stable growth for a considerable period of time, it could be a testament to their leadership. On the other hand, if we come across news that portrays the management in a negative light, it's better to stay away from the company. Thankfully, due to the technology, this can be done simply by googling the individual's name. This information can also be used to assess the competence of the promoters and management. It is also important to note the stake held by promoters in the company. Promoters holding a 50% or more stake in a company is a good sign. On the other hand, promoters holding a low stake in the business and news that they may keep selling is a red flag. You can find the promoters holding of any publicly listed company on screener.com. Simply go to the portal, search the company name, and navigate to the stakeholding pattern or shareholding pattern section. Another important section is relative party transactions. This section represents the transactions that company had with promoters or other entities or with the relatives or joint ventures. This section would reveal details if the promoters profit from the company at the expense of other stakeholders. Hence, the section must be studied in detail. The company's ethics are more crucial. We must review recent news on the ethics of the organization or participation in bribes of any kind. An additional factor to take into account is the value to the employees and their satisfaction. The internet is the greatest resource for finding all of these bits of information. Next, coming to business model. A business model provides a blueprint for future revenue generation. As an investor, you would like to understand whether a company will continue making money in future and how clear its future vision is. A model caters to both these requirements. It provides a clarity on the future objectives of the company as well as its strategy for future revenue generation. This puts you in a convenient position to decide whether or not to invest in the company. In a business model, we should understand what does the company actually do. The idea for a new product is what usually brings a company into existence. It is the source from which it expects to generate its revenue. A product is a central to a business model. The product may be a new tangible item, a service, an improvement over an existing product, or an outright replacement of it. Next question in business model is how company will do it. or what are the major sources of revenue. While in most cases it is obvious that revenue will come from those who buy the product, in some cases it is different. In case of TV channels and websites, customer pay nothing and all the revenue are generated from advertisements. Additionally, even when revenue comes from customers, the revenue model can vary. A revenue model can be chosen out from the subscription, commission, lease, or brokerage. Each of these has unique dynamic and must be matched with the product they are intended for. Next important thing we should know in the business model is who are the target customers. A product may be revolutionary, but it will not generate revenue if there are no buyers for it. Companies decide the target customers before they even conceive a product. This helps them decide its design and marketing strategy. Over time, new users may emerge. This may lead to target customer class change completely. A model must be farsighted enough to spot potential new customers and adapting the product accordingly. Next important thing in the business model is knowing about the product value. It means providing useful products and services that customers consider worthy of their time, energy, and money. Also, any business should be oriented to new present generation technologies. If these two things are matching, then it's a good sign to invest in that company. Next, coming to corporate governance or audit is an effective way to ensure that the company has complied with all the laws applicable and effective internal control system like appointing CEOs, organization structure, and other policies procedures are implemented well to serve needs of all the stakeholders. All communication in corporate governance reports should be clear and transparent to make it easily understandable for all stakeholders. Next, coming to moat or competitive advantage, an economic moat is a metaphor that refers to business being able to maintain a competitive advantage over their competitors in order to preserve market share and profits. Any method that a company uses to maintain a competitive edge can be considered an economic moat. A company with one or more competitive advantages is well positioned to execute its business strategy and grow sustainably relative to its peers. While analyzing the competitive advantage of any business, first we should understand their brand name, and it should have good market share, and there should be entry barriers for others to enter in that business, and it should have their own distribution network. Let's take an example to discuss all these things. Apple company is the world's leading brand from so many years. The company's strong branding and the interrelationships between its products encourages customers who buy one Apple product to try another. A key competitive advantage for the company is its ability to develop innovative products that share the same operating system, software, and applications. This minimizes the risk, timescale, and cost of product development, enabling the company to introduce a stream of new products and stay ahead of competitors. This Apple's innovative strategy of developing products that complement each other strengthens customer loyalty and helps build a barrier to competition. An ecosystem of suppliers, developers, and business partners provides Apple with a strong competitive advantage. The company owns chip manufacturers, controls manufacturing, follows extremely strict software standards, and operates its own stores. It also has a community of more than 6 million independent software developers creating applications for Apple products. This gives Apple control over the entire process of product development, manufacturing, and marketing, an advantage that competitors find difficult to match. Next, we will be discussing about the shareholding patterns. The shareholding pattern gives one an idea of how the shares of a company are distributed across different entities. Shareholding patterns are significant for trading because they give traders an insight into a company's financial health. Look for the shareholders pattern, which reveals investments by foreign institutional investors FIIs or domestic institutional investors DIIs. If FIIs or DIIs believes in the company, it's a good sign. As such, firms may generate attractive returns. It would help if you compared the shareholding patterns across multiple quarters to spot significant changes. If the promoter shareholding pattern keeps changing, you must find out why. If promoters are exiting their stake regularly, it may signify a lack of faith in the company's business. The last one is political affiliation. We need to know how the business is acting in response to political party shifts, or we should check to see if any management members are directly or indirectly connected with any political party. We should also be aware of any continuous support from political parties to the company. My advice is to stay away from the stocks of any company that is more dependent on political parties. Thanks for watching, and don't forget to subscribe for more valuable content on investing in the stock market.